Hello folks, Steve Lentz here with Discover Options and Option View. It's June 30th, 2017. Welcome to this presentation of 3 different timing reports. Presented materials for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So we have 3 different reports for you. These are primarily for advanced options traders. For those of you trading condors and butterflies, we have the Condor Butterfly Timing Report to help you determine if right now is a good time to implement a campaign in one of these strategies. Also, for those of you that like to lean your premium selling strategies bullish, we have the Bull Put Spread Timing Report. And then we also have the Directional Likelihood Report, just for some statistical likelihoods as to direction and volatility of the market. Okay, now before we get going, I want to make sure you know that you could get a free ebook by clicking on the link. This was co-authored by myself and Jim Graham. Just fill out the information and get the information to us. We will send you this free ebook, and I think you'll enjoy that. Also, we would love for you to subscribe. Just click the subscribe button, and you'll then get notices and everything when we come out with a new video. Here is the market condition we have right now. Clearly we had an inside bar on Friday. The high was lower than the previous high, and then the low was higher than the previous low. An inside bar that took place all while the market is above the 50-day simple moving average. And the 15-3 stochastic is between 15 and 65, but is above its 3-day simple moving average, or %D. This is kind of a unique market condition that's only occurred about 36 times since Jan of 2000. And so with this in mind, let's go through the reports and address condors and butters, bull put spreads, and then we'll take a look at the directional likelihood as well. So we go to the Condor Butterfly Timing Report, and so here it is. So since Jan of 2000, there have been over 4,300 daily closes of the SPX. Now, of these 4,300, 65 point, let me see, get the font a little bit small here from where I am. There we go. 65.3% have been favorable bars for selling premium, where the actual 21 bar movement that commences from there was less than the SIBO skew adjusted implied movement. Okay, so what that means is just over 65% of the bars were ones where the ensuing movement was less than what the options were implying. Now that's a good thing if you're selling premium through butters and condors, market neutral type strategies. So by flipping a coin 65% of the time, if you keep flipping the coin 65% of the time, you're going to have a bar that works out favorable for these strategies. Roughly 35% of the time, not so much. You're going to have a good adjustment approach, etc., and do a little work there. And here at Discover Options, we can certainly show you how to do that. Now, also during that time, since Jan of 2000, our current condition, as I told you earlier, has occurred 36 times. Now, of those 36 times, 72.2% of those bars were similarly favorable for option premium selling through condors and butters. Now this implies then a selling edge of roughly 6.9%, 72.2 minus 65.3. Okay, so statistically then, it's more likely than usual that the current market condition will end up being favorable for market neutral option premium selling strategies like condors and butterflies. Okay, and that's kind of where we're at right now. There's currently an edge when you run the numbers out on those 36 and compare it to the baseline of 60 of what the other 4,300 experienced. Okay, so let's now go to the bull put spread timing report. Is now a good time to put on a bull put spread, or maybe a butterfly or a condor, and you're leaning it bullish? All right, so here's the report. Since Jan of 2000, we know there have been around 4,300 daily closes of the SPX. Now of those, okay, 82.8% have been favorable bars for selling put premium a standard deviation away, a 1 month out. Okay, so a 21, so basically, so 82.8% have been favorable for selling put premium where the actual 21 bar downside movement was less than the SIBO skew adjusted implied movement to the downside. We're looking at selling an out of the money credit spread in the puts, a bull put spread, a standard deviation away, 1 month out. 82.8% of the time, okay, if you flipped a coin enough times, 82.8% of those coin flips would be bars where, on average, would be bars that turned out to be favorable, where the market did not go down that full standard deviation to the downside and hit your short put option. Okay, pretty good, right? Well, now also during that time, of course, as we told you, our current condition has occurred 36 times. Of those 36, 83.3% were similarly favorable, pretty much a wash. A tiny premium selling edge of just 0.5%, basically, between our current market condition and just, tossing a coin. Okay, so it's pretty much a wash. Statistically, it's just a tiny bit more likely that we'll end up having a favorable bar as of now. Okay, so that's the bull put spread timing report. When you run the numbers out, kind of a wash right there, pretty much the same. But 82.8%, not too bad. Just go ahead and model those, and you got to manage your risk, and we can certainly show you how to do that here at Discover Options. Now, let's get to the market likelihood report. Where's the market likely to go given our current market condition? Is it likely to go up, down, or wobble around for a bit? And so what you see here is a picture of price distribution. Most notably, you're looking up here where it says upper 5, upper 10, upper 15, lower 5, 10, and 15. What does all that mean? What we're doing is trying to paint a picture of price distribution. Okay, does price typically go up a standard deviation, down a standard deviation, or wobble around? And every 5, 10, and 15 days, what I'm doing here is creating distribution bands. Okay, and once we know the baseline distribution of the market, we're going to then look at our current market condition and see typically, of those 36 times that it occurred, what did the market do? Typically go up, down, or wobble around a bit. Well, how do we determine that? Well, we'd look at distribution, and I'm doing it through these 6 different bands. So here's what we have here. Let me show you. Here's just a picture of the bands. Just a second. Click. There we go. So what you're looking at here then is this is a 5-day distribution band. You have the close. This is the 5-day band, a standard deviation out of the money. This is a standard deviation out of the money to the downside. A 5-day 1 standard deviation level, and this is using the SIBO skew adjusted VIX levels to determine the width of these bands. So in the SPX, the out of the money calls have a lower implied volatility than the out of the money puts, and we're factoring that in here in that the upside is a little bit closer than the bands to the downside. Do you see that? Okay, so the question here then is, in 5 days, will price go up and hit that band at the top, or go down and hit these down below? Just over 5 days, and we're going to have statistics. We'll know of the 4,300 in the past, what the percentages that hit the top, or hit the bottom, or didn't hit those at all. Well, we'd measure this for both the 5. The 10-day bands are a little farther away because it's more distant in time, and then the 15-day bands as well. And so we're going to then go back and look at the 4,300 plus closes, and we're going to actually count and get the percentage. And indeed, when you look at this, of the 4,347 closes since Jan of 2000, the upper 5-day band was struck 21.4% of the time. The upper 10-day band, 15.9. The upper 15, 14.9. The lower 5-day band, 16.5 around, 16.8. 19.6% of the time, price went down and struck the lower 15-day band. Okay, so that's the baseline distribution right here. Right here. This is the baseline distribution. Now, for our 36, okay, timeout, there we go. For our 36 occurrences of our current market condition, of those 36, okay, price would go and hit the upper 5-day band, 16.7, which is a bit less than the 21.4 on the baseline. Okay, so that's why we have a negative number here. Price failed to reach that upper 5-day band. It failed to reach the upper 10-day band just by a little bit, 2%. It failed to reach the upper 15-day band by quite a bit. It would only hit it, 8.3% of the time. So we see here then, of the 36, it's failing to reach the upper bands across the board in terms of the amount. Now, does it mean it will never hit the upper 5-day bands or the upper bands? Well, no. It definitely has hit those upper bands, just not as often as the baseline market, as the market normally does. When our current market condition occurs, price ends up hitting the upper bands less often. And look at this, it hits the lower 5 and 10-day bands a little bit more often, 22.2% of the time for both of those, as opposed to a little bit less than 17. Okay, it hit the lower 15-day band a little bit less often than the others. So this is a picture, okay, of a bearish bias. It's failing to hit the upper bands, but it's hitting 2 of the 3 lower bands a little more often. Do you see that? Very interesting. So that's the distribution. We would lean it a little bearish if we had to pick. The likelihood is that the market would be a little more bearish. Does it mean it's going to? Well, no. We just know that there's a likelihood, given the history, there's a likelihood if patterns play on out. Okay, we are just quoting you the statistics here based upon how often, the 36 times that our current market conditions occurred in the past. Now, of these 36, 17 times the market would go up and exceed the previous day's high, that inside bar. Okay, when the high gets exceeded of that inside bar, the distribution is a bit more bearish. All 3 of the lower bands are getting struck more often than baseline. Okay, 2 of the 3 upper bands get struck less often. Okay, and then we come down here. If price exceeds the low of that inside bar, again, the upper bands across the board getting struck less often. 2 of the 3 lower bands getting struck more often. So again, a likelihood of more bearishness than bullishness, certainly. No guarantees, but we know that of these 36 occurrences, price ended up resolving itself bearish more than bullish, certainly. Okay, so that's the likelihood report. I hope you find that helpful. Let me go over here. Oops, timeout. There we go. All right. Thank you for joining us. I'm Steve Lentz with Discover Options. We'll see you next time. Bye-bye.